There's a piece of land in Britain that can pass from one generation to the next, completely free of inheritance tax. No loopholes, no offshore accounts. Just one word on the property deed: agricultural. Here's what most people don't know. In the UK, if you own a farmhouse with genuine agricultural land attached, you may qualify for something called agricultural property relief, APRA for short. It can wipe out up to 100% of inheritance tax on that property. Compare that to a normal house. If you inherit a £2 million home in London, the tax office can take a serious slice above the nil rate threshold, 40% on the value over the limit. That's hundreds of thousands of pounds gone. But a working farmhouse sat on agricultural land that's actually farmed. That same value can pass to your children with the tax bill reduced to zero. Same wealth, same family. Completely different outcome because of how the land is classified. This isn't some obscure clause. It's one of the most well-known estate planning tools among Britain's landed families, and it works through a few key layers. Layer 1: the farmhouse itself. For APRA to apply, the house has to be of a character appropriate to the land, meaning it's genuinely tied to a working farm, not a mansion with 2 chickens in the garden. HMRC has fought and won cases exactly on this point. Layer 2: business property relief, or BPR. If the land is run as an active farming business rather than just leased out, that business value can also qualify for relief, sometimes stacking with APRA to protect even more of the estate. Layer 3: long-term ownership and use. These reliefs generally require the land to be owned and actively farmed for a minimum period, typically 2 years if you farm it yourself, or 7 years if it's let to someone else. This isn't a same-day trek. It's a structure built over years. This is exactly why you'll see landowning families holding onto agricultural estates for generations. It's rarely just about tradition. It's one of the few remaining ways to pass down serious wealth largely intact. Now, before you go searching farmhouse for sale, this comes with real conditions. First, the land must be genuinely and actively farmed. HMRC checks. If there's no real agricultural activity, crops, livestock, and actual farming operation, the relief can be denied entirely. Second, the ownership and farming period matters. Buy a farmhouse the year before you die, and your estate likely won't qualify. This only works with time and genuine use behind it. Third, and this is a big one, the rules are changing. From April 2026, the government is capping how much APRA and BPR relief applies at 100% combined, with a £1 million allowance before a reduced rate kicks in on the excess. So the unlimited shield version of this strategy is being scaled back. This is exactly the kind of detail that makes tax planning something you revisit constantly, not set once and forget. Fourth, this is inheritance tax relief, not a way to avoid income tax on your salary or business profits. Rental income and farming profits from the land are still taxable as normal. The real lesson here isn't buy a farm. It's that in the UK, how an asset is classified and used changes how HMRC treats it when it's passed on. Most people think about tax as a fixed bill tied to how much they earn. But estate and property tax often comes down to structure: what you own, how it's used, and for how long. Wealthy landowning families didn't get lucky. They planned around rules that have existed in some form for decades. You don't need a 500-acre estate to think this way. Understanding reliefs like APRA and BPR, and the fact they're shifting in 2026, matters if you're inheriting property, thinking about long-term family wealth, or even just curious how the ultra-wealthy legally hold onto what they build. So next time you hear about a family estate passing down for generations without being carved up by inheritance tax, now you know one of the real reasons why. If this helped you understand how UK inheritance rules actually work, hit subscribe. Because next week I'm covering another legal strategy the wealthy use that most people have never heard of, and how the 2026 tax changes might affect it.